Are you new to investing and looking for a guaranteed way to grow your money without the headache of analyzing individual stocks? Welcome to our channel, where financial freedom is just a click away. Today, we are going to unveil the secret to consistent returns that Wall Street doesn't want you to know. Join us on this financial adventure as we explore the fascinating world of index mutual funds, a game changer for your portfolio and peace of mind. In this video, we'll demystify the concept, breaking it down into bite-sized pieces perfect for beginners like you. It's like having a seasoned financial advisor managing your money while you relax and watch your wealth grow. Section 1. Understanding Index Mutual Funds. Definition of Index Mutual Funds. An index mutual fund is an investment vehicle that aims to mirror the performance of a specific market index, like the famous S&P 500. Think of it as a virtual basket filled with a diverse selection of stocks representing the overall market performance. Unlike traditional mutual funds that involve active stock picking, index mutual funds take a more passive approach, mirroring the market's performance and steadily building wealth over time. How index funds work. Picture the stock market as a bustling marketplace with a wide array of goods, stocks, available. An index mutual fund manager acts as a savvy shopper, assembling a basket of goods that closely resembles the entire market or a specific market segment. By doing this, the fund's performance mirrors that particular market index. This investment strategy is based on the belief that the market tends to grow over the long term, and by participating in that growth, you benefit from compounding returns. Comparison with actively managed funds. You might wonder how index mutual funds stack up against actively managed funds. The main difference lies in their fund manager's approach. As mentioned earlier, index funds take a passive stance, aiming to match the market's performance without trying to beat it. This approach leads to lower expenses as fund managers don't need extensive research teams to analyze individual stocks continually. On the other hand, actively managed funds are like ambitious traders, attempting to outperform the market through selective buying and selling based on thorough research. While this approach can yield impressive returns in certain market conditions, it comes with higher expenses due to additional research and management fees. Studies have shown that, over the long term, the majority of actively managed funds fail to consistently outperform the market. This makes index mutual funds a smarter, cost-effective, and less risky option for many investors to participate in market growth. Section 2. Benefits of index mutual funds for beginners. One of the most compelling advantages of index mutual funds for beginners is their lower expense ratios. As we mentioned earlier, index funds follow a passive investment approach, significantly reducing the need for active management and research. Consequently, index funds tend to have lower fees compared to actively managed ones. These lower costs may not seem significant in the short term, but over time, they can add up to substantial savings, boosting your overall returns and helping you achieve your financial goals faster. Diversification is a cornerstone of smart investing, and index mutual funds have mastered this concept. When you invest in an index fund, you're essentially buying a piece of hundreds or even thousands of companies that make up the underlying index. This instant diversification across various stocks within the index helps spread the risk, reducing your exposure to the fortunes or misfortunes of any single company. As a beginner, this built-in diversification can provide much-needed peace of mind, especially during turbulent market times, as your investments are not reliant on the success of just a few individual stocks. Unlike complex financial products or strategies, index funds require no in-depth knowledge of individual companies or stock-picking expertise. With index funds, you're essentially betting on the overall growth of the market, which has historically shown an upward trend over the long term. This simplicity eliminates the need for constant monitoring and decision-making, freeing you up to focus on other aspects of your life while your money quietly grows. This inability to consistently beat the market can lead to disappointing returns for investors. In contrast, index funds aim to match the performance of the market they track. While they won't deliver astronomical gains during market booms, they are also less likely to suffer significant losses during downturns. Now that we've covered the enticing benefits of index mutual funds, you may be eager to get started with your investment journey. The first step is to open an investment account with a reputable brokerage firm. Once your account is open, it's time to choose the right index mutual fund for you. The first is the fund's expense ratio, as lower fees mean more money stays in your pocket. Next, review the fund's historical performance to get an idea of how it has fared over time. Different indexes represent various market segments, so choose one that aligns with your investment goals and risk tolerance. Market volatility can make investing feel intimidating, especially for beginners. However, one strategy that can help manage this uncertainty is dollar cost averaging. This approach involves investing a fixed amount of money into your chosen index fund at regular intervals, regardless of market conditions. By doing so, you buy more shares when prices are low and fewer shares when prices are high, effectively reducing the impact of market fluctuations on your overall investment. Section 4. Tips for successful index fund investing. Index mutual funds are designed for long-term growth, and trying to time the market or make frequent changes to your portfolio can hinder your success. Resist the urge to react to short-term market movements, and instead, stay focused on your long-term financial goals. To maintain your desired level of risk and return, it's essential to periodically rebalance your portfolio. This involves selling some of the outperforming assets and reinvesting the proceeds into underperforming ones. The stock market can be highly emotional, and fear and greed can lead to impulsive decisions. Remember that successful investing is based on a well-thought-out plan, not knee-jerk reactions. Avoid making drastic changes to your investment strategy based on short-term market movements or sensational headlines. In conclusion, index mutual funds are an excellent option for beginner investors seeking a simple, diversified, and cost-effective way to grow their wealth. Remember, before making any investment decisions, do your own research and consider seeking advice from a qualified financial advisor. If you found this video helpful, don't forget to give it a thumbs up, subscribe to our channel, and ring the notification bell so you never miss an update.